Alrighty, welcome YouTube. My name is Gabriel. I am the other person that also owns this YouTube and also Discord. So it's basically two of us, two mentors, completely free as of right now, and we're just going to keep on providing free content. So basically what we're doing is this Bootcamp Part 2. The whole point of this is to condense the TGR Bootcamp, just in our own way, condensing absolutely everything. If you see a bunch of pop-ups, I just posted a video for my gym brand. If you don't know me, me and him have been trading for about like 2.5 years, about a year consistently. And we want to provide the free content right now because, there's so many like bad knowledge out there and we want to actually do it. So this is Bootcamp Part 2. We're going to be going over liquidity sweep, fair value gap, IFVG, and draws on liquidity. Honestly, this video is probably going to be your most important video out of all of the boot camps. But yeah, we're basically going to be breaking down everything. I had someone ask me already to do a breakdown of how to use TradingView. We'll do that in another post. I did a psychology video earlier today, so if you guys want to check that out, it'll be at the end of this video. It'll pop up. So yeah, let's get right into this. This is gonna be very quick, very simple. Like I said, I want to really condense this for you guys to save you guys some time. Okay. Also, if you're curious, of course, I have a free Discord, blah, 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 blah. Everyone has a Discord nowadays, but yes, I have a free Discord. I don't live trade into it, but I give out free signals just for now. And I do back tests. I do live sessions of like answering people's questions and all that. I was going to go live on TikTok, but honestly, I don't want to do that. There's too many brain dead people on there. So, yeah, so we're just going to do this. We're going to go over the bootcamp. And if you guys want to join the free Discord, if you have any questions, it's completely free. And yeah, so let's get right into this. So first we have liquidity sweep. Liquidity sweep is extremely easy concept. You could technically do a liquidity sweep on the 1 hour, 4 hour, 1 minute, 30 second. It doesn't matter. So I'm just going to draw it out just to make it very easy for you guys to perceive. So let's say we have a candle right here. I'll change the colors for you guys right now. So let's say we have a candle right here. Let me get this out the way. We have a candle right here. Boom. And you know what? I'll probably just, let me just make it easier for you guys. Let me just show you it. So let's just go, let's say on the 5 minute. It does not matter what time frame you're on. So liquidity sweeps are literally like boom, right there. I just found a liquidity sweep. So it's literally where price is taking out a high or a low, right? So, and the reason why it's important is because that follows through with everything and it follows through with your draws on liquidity. So your draws on liquidity are a liquidity level that is a strong level of a session high and a session low, meaning that when price goes up there and hits that level, it's probably going to give a good reaction. So for example, we're right here. Asia high is right here. We come down. Asia low ends right there. And look at that. The end of the session, boom, we come and tap that Asia low and look at that crazy reaction that we get, right? London opens now. So now we start skyrocketing. London created a London low. But we already took out that Asia low. That's the reaction that we got up, right? And then when we came up here, what do? We swept Asia highs. So now that's a strong liquidity sweep. This is how you want to mark out your liquidity sweeps. You place a black line right there, and boom. So to give this a better perspective for you guys, this is what it looks like right now. Price came all the way up here, gave a strong reaction right here. So then you would just wait for a lower time frame confluence. And look at that. That's a beautiful 5 minute candle. And it got retraced into and everything. Look at that. So we're gonna go over fair value gaps right now. Boom. That's it. Liquidity sweep is where price. That's liquidity sweep and draws on liquidity. So draws on liquidity is where you get your session highs and lows, and that's the liquidity level of high and low of that session. So those are like really strong confluences. But let's say I didn't have this this indicator, right? You don't need the indicator. It's completely free. It's ICT kill zones on TradingView. But a liquidity sweep, for example, this is really nice. This is what these I wouldn't really call liquidity sweep. These are called key levels, where it's a certain area where price consistently hits and it sweeps on that level. So for example, price comes down here, boom, we shoot up. Okay, cool. Price comes down here, we got a decent reaction. Price comes over here, we come back down. We break through the level, okay, now where do we go? We come back to retest the same exact area of interest. So that's called a key level because it's a key level of where price is interested in reacting off of. So that's a beautiful key level. Look at this beautiful key level right here. Price comes right here, taps right here. We break through that level. Where does price retest? It retests on that beautiful key level. And without even realizing, that key level is the Asia high. And then look at that. That same key level that was previously made is the New York PM low. So that's an example of draws and liquidity. Draws and liquidity are your most overpowered thing when it comes to trading, in my opinion. I do trade IFVG, but not strict IFVG. I actually trade a more confluential continuation of it. But Colin, which is the other guy, he trades IFVG. So boom, that's it. Liquidity sweep, very simple. Also, there's mini liquidity sweeps. So let's say you want to go down to, like, obviously higher time frame is more strong, but let's say you want to go down to the 1 minute, right? And you want to wait for like a 1 minute like sweep or something like that to like retest. My bad. Let me get this out the way. You would go over here, and then, for example, this is a level that we would want to sweep, right? So then when we come all the way over here, we hit this level, I'm expecting a nice reaction. And then look at that. With that reaction, you get an inverse fair value gap. You could enter right there. I personally don't, but you could enter right there, put your stops at that low, target the next liquidity level, which would be right here. So this would be my version of pushing to break even. So meaning the second we hit this level, my stop loss gets pushed over here, meaning I'm not risking anything on that trade. So yeah, so right there, the break even, and then my next TP would be right here, and then my third TP, if that's higher, would be right there. And then if I want to, if you want to keep on holding it, if you're a maniac, all the way up there. And look at that. That literally would have hit, which is absolutely crazy. That's an insane trade. Nobody's holding that. But you get the idea. So that's a beautiful liquidity sweep. So let's get into fair value gaps real quick. So fair value gaps are extremely easy. They're super easy. So in order to make a fair value gap, you need 3 candles. One right there. Let me make this line for you. One right there. I'll make this, let's do a bearish fair value gap. So bearish, by the way, if you didn't see the last video, is down. Bullish means up, okay? Make sure you guys write this down in a notebook. Honestly, that's the only way that you're going to learn. That's the good thing about TGR Bootcamp, that he makes sure that like people do that, you know? So you really want to make sure you do that for yourself. It's the only way that you're really going to learn. You need to make sure you write it down and shit. So, boom. So now we have a continuation of 3 candles. Now they don't have to be the same. So I did 3 bearish ones just to make it easier for you guys, but it doesn't matter. Meaning that this one can be green, and then this one can be red, this one can be red, or this one can be red, and then this one's green. So if you want, let's make a good scenario. This is a perfect scenario right here. Let's say we get a bullish hammer right here. You're gonna see this every single hour, every single 10 minutes of the market. This is a fair value gap. So a fair value gap is where price left a gap in between the wicks of the candle. So this right here is indicating that I really want to see this. I really want to see, oh shit, wrong one, my fault. I really want to see this. 2 things. I can see, depending on my outlook, I could see a retest right here, get a nice reaction down right here. That would be my entry, putting my stops right here. Or we can do something like this, where we inverse the fair value gap. So inverse fair value gap means that a candle opens up and closes above that fair value gap. So then for me personally, I would want it to retest back into here and continue to go up. But a lot of the times it doesn't. A lot of the times it just does this, where price will come over here, close right here, and it doesn't even retest, it just continues up. So that's an inverse fair value gap confirming market structure is shifting. So to put that in perspective, let me just give you guys a great candle. Let's say we get a bullish hammer after sweeping. Let's say we swept liquidity right here. We're talking about liquidity sweep. Let's say we swept liquidity right here. We got a bullish hammer. We got a fair value gap. Let's say we created that fair value gap. And now this candle closes as an inverse fair value gap. This is a great indication that that liquidity level was strong. And now I want to put my stops at that level and target the next liquidity level, right? Because that's an inverse fair value gap. That's a great reaction, okay? That's both. That's fair value gap and inverse fair value gap. So I'm going to show you guys some examples right here, and then that'll be it. Very simple. Like I said, higher time frames are a lot more important. So you want to get a higher time frame fair value gap and then go down to your lower time frame to get like an inverse fair value gap. So like let's say, for example, right here, let's say, for example, we are right here, right? I have let's go down. Let's go up to the 15-minute. They're all over the place. Okay, they're literally all over the place. So let's say I go, let's see, right here, right? Let's say I go right here. I have a 15-minute fair value gap right there, right? So price came right here. Look at that bullish hammer, but instead it retested and shot down. Okay, so fair value gaps are super important. So let's say we're on that right there, and let's say that didn't happen, right? I would want price, since we're in this downtrend and we want this beautiful key level, I would want to target that key level as my TP. We left the fair value gap. Let's go right here. So now what I would be waiting for is a really strong shift down. Obviously, I'm not trading at midnight, but I would wait for a really strong shift down. Look at that. Price gave us a fair value gap, and look at that. Now we inversed. Give me 1 second. We inversed. And then there's two things that you could do. With me, I like to see price do this. I like to see price give us the inverse fair value gap, and then after that, retest into the new fair value gap created to continue to go down. That's what I like to do just to get better entries. It is slightly, no, I wouldn't say it's slightly more risky. It just depends. I don't always do that. In this situation, I wouldn't, just because of the reaction that we got. So then stop loss will go right here. I personally always leave a little bit of space, and then I'll target the next liquidity level. That will probably be my break even, and then I just scroll back, and I don't even think there's anything, so I probably wouldn't target anything else. So that would be my TP, and that's it. So let's see. Let's enter this sell, put stop loss at this high, and TP at this low, and let's see if it plays out. Boom, straight to TP, just like that. That is literally the IFVG strategy right there. So yeah, very simple. I just taught you fair value gap, inverse fair value gap, draws and liquidity, and liquidity sweep. So if you guys enjoyed this video, this is mini bootcamp part 2. Probably gonna post mini bootcamp part 3 tomorrow, and probably do a little video describing how to use TradingView. But yeah, if you guys really enjoyed the way I taught about this, bro, just join the Discord, completely free. And hope you guys have a blessed day.